definitions and terms which are used in this marginal costing. One is fixed cost, I said, and this fixed cost is a fixed cost which doesn't change in a given period or for a given capacity. Let me give some examples. Now, for example, take an example of a factory. Now, in a factory, production takes place in the factory. So, in that factory, the material is used for the production. So, that is variable. Say, for example, in it is a garment factory where say shirts are manufactured. Now, say for one shirt, 2.5 meters cloth is required. So for 1000 shirts, 2.5 into 1000, 2500 meters cloth is required. So material cost of that cloth is variable cost. Now suppose for one shirt, that worker is paid at the rate of say rupees 100. So if that worker stitches one shirt in a day, he will get 100 rupees. Suppose that worker stitches 5 shirts in a day, he will get 500 rupees. So the amount paid to the workers is also a variable cost which changes with the production. But in the same factory, there is a factory watchman. Now, factory watchman salary is say 20,000 per month. So that 20,000 rupees salary paid to factory watchman will not change whether you manufacture one shirt in the factory or 100 shirts in the factory or 1000 shirts in the factory. That 20,000 rupees salary of the factory watchman will not change. Similarly, suppose that factory is the factory not owned by the business, that factory is taken by the business on a rental basis, and for that, the business is paying, say, 1 lakh rupees rent per month. So, this 1 lakh rupee rent per month paid for factory is a fixed cost. Because whether you manufacture one shirt or 10 shirts or 1000 shirts or 10,000 shirts or no shirts, this rent is to be paid for the factory. So this type of costs are called as fixed costs, and in marginal costing, this fixed cost never changes up to 100% capacity or up to a given period. What is really very important is a variable cost. I said variable cost is that cost which changes with the number of unit produced. Say I said rupees 3 for 1 unit, so rupees 6 for 2 units, rupees 300 for 100 units, rupees 3000 for 1000 units. So it changes directly the way I said for shirts. 2.5 meters is required for one shirt. So for two shirts, 5 meter, like that. Now, in marginal costing, very important word that we have to understand, which we use every now and then, is contribution. Now, what is contribution under marginal costing? It is very simple. For every additional unit you manufacture and every additional unit you sell, what difference you get, that we have seen in the previous example of that 1 lakh pens, that is difference between sales and variable cost, is called as contribution. In that example of 1 lakh pen, that 4 lakhs was received by way of sales and 3 lakhs were incurred by way of variable cost. So 1 lakh was the contribution, and that 1 lakh was net increase in the profit of the business. So in marginal costing, the business is worried about the contribution and not the profit. So in normal cases, business is worried about profit, but here in marginal costing, business is worried about the contribution, and ultimately this contribution increases the profit of the business. So how it is calculated? Sales minus variable cost. In short form, we say S minus V, and sometimes we calculate this in amount wise, sometimes we calculate this per unit, as the case may be, which we'll see in the following slide. So these three important amounts which we have to understand: fixed cost, which doesn't change up to the full capacity or for a given period of time; variable cost, which always directly changes with the number of units manufactured or produced. It could be material, it could be labor, it could be any other direct variable cost also. And then contribution, this is nothing but the difference between selling price and variable cost. It is S minus V. Now let us see different formulas which are used in marginal costing. Now don't get bogged down by this formula. They are very simple, but we don't have to by heart them. We have to understand them logically. First one is profit. What is profit? It is sales minus your total cost. What is total cost? Variable cost and fixed cost. So sales minus total cost, that is variable cost and fixed cost, is profit. Very simple. Now this formula you can change the way you want to. Suppose that variable cost you take on this side and profit you take on the other side. So that minus variable cost will become plus. So variable cost is equal to sales minus fixed cost, and this profit will come on the other side, it will be minus. So in short, variable cost can also be calculated as sales minus fixed cost minus profit. Now again, suppose that minus fixed cost you take on the other side and variable cost you take on the other side. So fixed cost will be plus and variable cost will be minus. So fixed cost is equal to sales minus variable cost minus profit. Again, this this sales you take on the one side and other things you take on the other side. So it will be sales. What is sales? It is total cost plus profit. What is total cost? Variable cost plus fixed cost. So one can say sales is equal to variable cost plus fixed cost plus profit. Now contribution, I said it is sales minus variable cost. Now profit volume ratio. This is one of the very important ratio that we calculate in every marginal costing problem as a part of solution. What is the profit volume ratio? Very simple. It is contribution, that is S minus V, divided by S, that is sales minus variable cost, that is C, divided by sales, that is S, into 100. So if anybody asks you what is profit volume ratio, it is contribution divided by sales into 100, and contribution is what? Sales minus variable cost. Now, break even point. What is break even point? In any business, the break even point of the sales we say is that particular point where the total sales is equal to total cost, means the business is having no profit, no loss. So break even point of sales is that point where total cost is equal to total sales. And every business is interested in knowing this break even point sales, because below this break even point sales, business will always have loss. And beyond this break even point sales, for every increase in the sales, the business will have a profit. So this break even point sales is a very important factor in marginal costing. When it is in terms of sales, the formula is fixed cost F divided by PV ratio, that is given. And then suppose this is in terms of units, how many units we have to manufacture and sell to have break even point. Then break even point in units is calculated like this. It is fixed cost divided by not PV ratio but contribution per unit. So whenever it is break even sales, it is fixed cost divided by PV ratio, and whenever it is break even point units, it is fixed cost divided by contribution per unit. Then we have margin of safety. Now, what is the margin of safety? Very simple. This is actual sales minus break even point sales. Now, if your actual sales are more than break even point sales, this margin of safety is positive, and that indicates the business is having profit. But whenever actual sales is less and break even point sales are more, the answer is negative. So margin of safety is negative, and where margin of safety is negative, it indicates loss. So margin of safety tells whether the business is in the profit margin or in the loss margin. And how margin of safety is calculated? Actual sales margin, break even point sales, not units. And then there are other two very important things which we ask you in the marginal costing problem. Expected profit. So we'll give you actual sales, and from that actual sales you have to calculate what profit the business is expecting. So very simple, it is actual sales minus break even sales, so margin of safety. So margin of safety into PV ratio will be your profit. So whenever expected profit, that's actual sales is given, and then break even sales we calculate, the difference between the two is margin of safety, and when you multiply that with PV ratio you get what? The expected profit at the actual sales given. Now it could be like, what should be the expected sales to have 2 lakhs profit or 5 lakhs profit? So here some profit is anticipated, and to have that much amount of profit, business is asking that accountant, tell me what should be the sales level. I want 10 lakhs profit, tell me what should be the sales. I want 50 lakhs profit, tell me what should be the sales. So in such a case where expected sales is to be calculated and we want a definite profit, the formula is very simple. It is fixed cost F plus expected profit, and this total we divide by PV ratio. And these are the formulas that we have to actually logically understand. Don't by heart. See, if you write these formulas logically and you practice problems, you can answer any simple problem on the basis of this, even complicated problem.